Welcome back to the deep dive.
Mm.
We are getting into something today that is, well, it's honestly pretty terrifying if you don't see it coming.
Terrifying is definitely the right word for it.
Right. Because if you spend, any time at all on financial social media lately, you are entirely familiar with this whole narrative around day trading.
Oh, yeah. You see it everywhere.
Exactly. You scroll your feed and it's just endless screenshots of people's daily P&L statements.
Yeah, the aggressive options plays, people skimming profits off volatility.
Right. Everyone bragging about how they're getting rich quick,
Mm.
just beating the market from their phones. But the source material we have today, which is this really detailed article called The Hidden Tax Pitfalls of Day Trading, it totally strips away the hype.
It really does. It completely ignores the actual market strategies and looks right at the structural reality of what happens when you make hundreds of trades a month.
Yeah. And our mission today is to uncover this invisible reality. We're going to explore how a massive winning streak, like a genuinely great year of day trading, can secretly bankrupt you.
Which is the last thing anyone expects when they're making money.
Okay, let's unpack this. We are looking past the mechanics of the trades themselves and digging directly into the back-end accounting traps.
Right, and it's important to establish upfront that this deep dive isn't just about standard market risk. Everyone knows the stock market goes up and down. This is about the invisible traps built directly into the tax code that catch new investors completely off guard.
Yeah, and the source makes a really crucial distinction right at the start, contrasting standard investment advice with the actual mechanics of day trading.
Right, because standard advice is usually to take a long-term approach, right?
Exactly. You buy, you hold, you ride out the losses while the market recovers over years.
But day trading is the complete opposite of that.
It's frantic.
Hmm.
It's a super high-risk approach. You're buying and selling securities within a single day just to lock in and compound these tiny short-term gains.
And the source emphasizes something really important here. Day trading can be lucrative. It definitely can. But really only if you are a professional investor with a massive amount of resources and expertise.
Right, like institutional trading desks.
Exactly. Professional firms operate with these integrated real-time tax liability tracking systems.
They've got the big, expensive software.
Right, algorithms specifically designed to monitor their tax exposure on a trade-by-trade basis. They see the whole board.
Whereas the amateur, the new investor who just downloaded an app, they completely lack those resources.
They are flying blind.
They really are. They're making these rapid-fire decisions based solely on the market data on their screen, completely oblivious to this compounding tax liability just quietly accumulating in the background.
And as the text warns, that means amateurs can lose a lot of money in a hurry.
And the financial hit doesn't even show up when the market closes.
No, it doesn't.
It waits. It extends far beyond the trades themselves, right into tax season. So I want to jump straight into the absolute nightmare metric the source covers.
Yeah.
The biggest tax cost that new traders literally never see coming.
The wash sale.
The wash sale.
Yeah.
Let's just define the trap clearly based on the text. A wash sale happens when you sell a stock at a loss, and then you buy back, quote-unquote, substantially the same stock within 30 days before or after that sale.
What's fascinating here is the devastating mechanic behind this rule.
How does the IRS handle it?
When you trigger a wash sale, the loss from that sale is completely disallowed.
Wow.
The IRS treats it as if the loss never happened at all. You cannot use it to offset your capital gains.
Which just sounds like an administrative annoyance if you're a long-term investor.
Sure, if you trade once a year.
Right. But for a day trader who is moving in and out of the exact same stock multiple times a day,
It becomes a disaster.
and we have to talk about the specific anecdote from the source material because it is jaw-dropping.
It's the perfect example of this trap.
Yeah, so the authors of the text recount this story about a 24-year-old client who called them on a Saturday morning.
Right, he was in full panic mode.
Complete panic. Because he had been day trading heavily, and by the end of the year, he had actually made money. He made about $200,000 on his investments.
A really solid year of trading.
Amazing year. But because of these disallowed losses from wash sales, when his tax return was calculated, he owed a staggering $2 million in taxes.
$2 million in taxes on a $200,000 profit.
I mean, mathematically, how does that even compute? It's just shocking.
It is shocking, but it highlights the text's exact point. It is entirely possible to owe more in taxes than you actually made.
Let's break down the math for the listener, because I think people hear that and think it must be a typo.
It's not a typo. It comes down to the difference between your net liquidation value and your taxable gross income.
Okay, so net liquidation value, that's just the reality of your brokerage account, right?
Exactly. It's the cash you can withdraw. Your starting money plus wins minus losses. For this 24-year-old, his account was up $200,000.
But the IRS doesn't tax that number.
No, they tax your taxable gross income. So imagine a micro example. A trader has $50,000. They buy a volatile tech stock, it dips, and they panic sell for a $1,000 loss.
Okay, down 1,000.
But an hour later, the stock rebounds. So they buy back in, ride the wave, and sell for a $1,500 gain.
So for the day, they're actually up $500 in their account.
Right, but for taxes, because they bought back and within 30 days, that first $1,000 loss is a wash sale.
That's disallowed.
Disallowed. So the IRS only sees the $1,500 gain.
Wow.
Now imagine doing that 50 times a day, recycling that same $50,000 over and over for a whole year. You could easily generate $10 million in gross winning trades and $9.8 million in gross losing trades.
Which leaves you with the $200,000 net profit.
Exactly. But if you never took a 31-day break from trading that specific stock, all $9.8 million of those losses are disallowed by the wash sale rule.
So the IRS says, congratulations on your $10 million in income. Please pay us $2 million.
And you owe money you physically do not have.
It is genuinely a financial nightmare.
Yes.
So obviously the natural question here is, can you outsmart the system?
People certainly try.
Right, like playing a shell game. Can I sell an investment at a loss in my regular taxable account and then just log into my tax-advantaged account like my IRA and buy it back there?
The text warns about this specifically. You absolutely cannot get around the wash sale rule by doing that.
The IRS caught on to that.
They did. And it's actually a very dangerous misconception because the rule applies to the taxpayer, not the specific account.
So the wash sale still triggers.
It still triggers. But here's why it's worse. Normally with a wash sale, the disallowed loss gets added to the cost basis of your new shares. So you eventually get to claim the loss down the road.
But in an IRA.
You can't claim capital losses in an IRA anyway. So when you force that wash sale into your tax-advantaged account, the loss is permanently destroyed. You never get to claim it.
That is brutal. So trying to be clever actually increases your lifetime tax liability.
Exactly. And if we connect this to the bigger picture, every angle of day trading pushes the investor into a higher tax bracket or a penalty.
Because even if you miraculously avoid every single wash sale, let's say you're a genius with a spreadsheet and you track everything perfectly.
You're still facing another painful reality from the source.
The income tax rate.
Right, because you're holding these assets for such a short amount of time, your day trading profits will most likely be taxed as ordinary income tax.
Rather than capital gains tax.
Exactly. Standard investors who hold stocks for over a year get the typically lower capital gains tax rate, but day traders are dealing exclusively in short-term gains,
Which just gets stacked on top of your regular salary and taxed at your highest bracket.
guaranteeing a significantly higher tax liability just for playing the day trading game.
The friction is just massive. But the text does mention one potential silver lining, right? An official IRS designation.
Yes, filing for trader tax status with the IRS.
Trader tax status, or TTS. But the text makes it clear this isn't just a box you check on TurboTax.
No, the strict hurdles are immense. To get TTS, you must actually be in the business of trading.
Meaning what, exactly?
Meaning you have to meet a series of rigid requirements. You have to trade substantially all year long. We're talking hundreds of trades nearly every single day.
Treating it like a full-time job.
Exactly. You must spend hours a day researching and executing, and your primary intent has to be profiting from daily market movements. If you have a normal full-time job and just trade on your lunch break, the IRS will not grant you trader tax status.
But if you do qualify, and you follow all guidelines exactly, it can save on taxes.
It can. It allows you to make a special accounting election that essentially nullifies the wash sale rule and lets you deduct your trading losses more freely.
But you have to commit to it in advance.
Well, in advance, by the tax deadline of the prior year.
Which means most new traders won't even know it exists until it's way too late to help them with their current tax bill.
Right. They find out about it in March when their accountant tells them they owe $2 million.
So if a new trader can't get trader tax status, and they don't want to get destroyed by wash sales and income taxes, the text offers one final workaround.
And it's a drastic one.
It says if you want to day trade and avoid these tax issues altogether, the alternative is to do your day trading directly inside your IRA.
Because the IRA is a tax-sheltered environment.
Right. You don't report individual trades to the IRS, so wash sales inside the IRA essentially don't matter, and you don't pay immediate taxes on the short-term gains.
But that brings up a really massive contradiction in the strategy.
Which brings us right to the summary of all this. Because what we've learned today is that day trading without professional resources is basically like walking through a financial minefield blindfolded.
It really is.
I mean, we saw how easily a $200,000 profit can turn into a $2 million tax bill, thanks to the invisible trap of wash sales and income tax classifications.
The structure is just incredibly unforgiving for amateurs.
It is. And that leaves us with that final tip from the text to mull over.
Right, the suggestion to day trade inside an IRA to avoid the tax issues.
That sounds like a neat life hack on paper.
But think about the reality of what that means. The text explicitly warns that day trading is a high-risk strategy where amateurs can lose a lot of money in a hurry.
Right.
But an IRA is fundamentally designed as a safe, long-term safety net for your retirement.
That's your survival money for when you're older.
Exactly. So here's the thought to leave with. Does utilizing your IRA to execute high-risk daily stock gambles actually solve your problem? Or does it just replace a massive tax risk with an even more devastating risk to your future survival?
Because if you blow up your retirement account trying to beat the market, there is no tax deduction that can fix that. That's a permanent loss of your future security. Something definitely worth thinking about before you start day trading from your phone. Thank you so much for joining us on this deep dive. Stay curious, keep exploring the hidden mechanics of the systems around you, and we will catch you next time.